Hey everyone, welcome to the fourth video in the series. We're going to talk about trading systems and risk management profiles in even more depth. So, what do I use for creating these equity curve simulations? I use this tool from surrogatetrading.com, so thanks to them. I've been using this for years, and I don't know, I just really like it. I believe FTMO has one too, so you can always use that, but I just use this because I'm most comfortable with it. And that's what I use to put all of these graphs together for this video series. So again, let's quickly review, right? The different types of risk systems that we recommend. Again, 0.25% risk per trade. 0.5% risk per trade is the one that I personally recommend. And I think it's better overall because it gives you a little bit more exposure. The problem with the 0.25% risk per trade system is there is a chance that you're going to go in and kind of take trades that are mid probability because you can afford to do it, right? So that's why I suggest the 0.5% risk per trade system. It's just you'll be a little bit more conservative in the sense that you should just take the high probability setups, right? Obviously you have a little bit more exposure, right? So a little bit more risk, a little bit more reward, right? These are both the same systems with 5R and 30% win rate, right? 5R on average is what we would be winning on our trades, right? But you can see the huge difference between our average performance, right? Now, the thing is, I don't want to say that 0.25% risk per trade is bad at all. Because listen, if you're managing a huge 7-figure account, for example, right? Listen, 5% per month, right? If we're taking one trade per day, and this is a sample size of 100 trades, right, over a period of a quarter, right, 3 months, 5% per month is pretty damn good, right? If you can do that all 12 months of the year, even 10 months of the year, we're talking 50% gain, right? That's pretty good. I mean, I wouldn't sneeze at that. That's some good performance. On the other hand, like if we look at our 0.5% risk per trade, if we're trading a prop firm account or something, right? And same thing. Look, average performance, 50.3%, right, over a quarter, 100 trades. A trade per day, roughly, right? Maybe some days you don't take any trades, some days you take a couple or 3 or whatever, it ends up evening out, right? And that's pretty good, right? Average performance of 50%. So what is that? 50% divided by 3. I'm not good at quick math, you guys, but if you want to whip out a calculator, go for it. You get the idea, right? But what's the thing to note on both of these? What's our total loss risk? Our risk of ruin is 0.1%, right? That's pretty good. Obviously, we want to get it to 0.0001%. We can't fully eliminate the total loss risk. There are external factors like our trade psychology and different stuff that can affect that, obviously. But we want to try and manage it. So quickly, I want to talk about the aggressive risk system for flipping buffer and profits again. Again, I need to warn you guys. If you're not an advanced trader, please just ignore this entire slide. But for those of you who are advanced and are experienced and have proven an edge over a very consistent, over a long series of trades with a consistent system, right, within your system anyways, right? Because all of our systems kind of vary within Phantom between, the members and stuff. I know certain people take certain different setups, right? But here's the thing. If you have a track record and you feel confident doing it, and you've built up a buffer, in a prop firm account, for example, maybe you've built up a 5 or 10% buffer and you're willing to lose that, right? Then I'd say it's okay. Take it, use it to flip buffer, right? And profit on it, right? The thing is, it can quickly eat profits, as I showed you guys in the previous video, and it can very easily turn into gambling if you don't have the discipline to stop when you're on a losing streak, right? Remember, it requires a bit higher of a win rate. And again, pay attention to this last point, guys. Avoid risking 1% if you are new to trading, even if you're an intermediate trader. I don't even risk 1% per trade yet. I probably won't for a while. I just feel more comfortable having the buffer, right? It's literally the difference between, if we're in a prop firm account, we're talking, I have 10 chances to lose versus 20 chances to lose, right? To hit that 10% drawdown. And what's our total loss risk? Look, it's actually 1%, right? Based on, 5R and on average, right, which I think is the minimum that we can expect to make. It's usually the minimum I think anybody in the Phantom community targets, right? And that requires a 35% win rate. So just be mindful of that, right? I wanted to include it and show you guys a simulation of it as well, so we can kind of get an idea. But that's pretty good, right? Now let's talk a little bit about trading systems in more detail. So let's talk about trade frequency and exposure to risk, right? Typically for most beginner to intermediate traders, the higher the trading frequency, the more inherent risk you're going to be exposed to. Why is that the case? Well, it's because when you're learning, it's very likely you're not going to be that good at spotting high probability setups, right? So, if we're overexposing ourselves to risk by, taking like 10 trades per day or something crazy like that, right? It's very likely you're probably taking like low probability setups and not even realizing it. So we want to avoid taking too many trades at the start, right? Now, I'm not telling you guys to be fearful of taking trades, right? But have some rules set in place. I'm going to talk in more detail and depth about this on the next video when we're talking about trade psychology a little bit and how it relates to risk management. But in this case, again, if you're starting out, you're very likely going to take subpar setups, right? So it's best that you really spend the time, and this is again more so at the start, learning your trade system and really like putting together a proper entry model, or taking the entry models that we put in resources or whatever, right? There's nothing wrong with doing that. You can take it, learn it, practice it in recaps, in backtesting, demo, whatever, right? Get really good at it, right? But why did I put that point in there? Because listen, I'm guilty of doing it. I've gone on crazy trading sprees where I'm kind of gambling, and I'm taking like 10, 12 positions in one day. It's like, you don't want to be doing that, right? I think statistically, it was my Forex funds that released like a little like study on all of their funded traders, and I guess people who've lost their funding, but they were saying that their most successful traders only take like 2 or 3 trades a day, and then they actually stop after that. So it's a cool little data point. On top of that, apparently like 60% of traders don't use a stop loss. So I don't think I know anybody in Phantom that doesn't use a stop, but pretty crazy when you think about it. But yeah, that should tell you, right? Like, it pays to be conservative in a sense. But again, the exception to this rule is if you're an advanced trader and you know what your prime setups are, you've mastered your entries, your trade management, you're consistent, you have a good track record and data of like 100 plus trades, live trades, right? You have a relatively high accuracy in respect to your trading system, right? Depending on what your trading system is, then I'd say it's okay. Maybe you can take 2, 3, 4 trades a day more, right? As long as you're winning them, right? And even then, if they're prime setups, like I said, you should be tackling these setups, right? You should not be fearful to enter a trade that fits really well within your plan. If it's high probability, take it, because you don't know if it's going to result in a winner or a loser, right? There is no way to know. There's no concrete way to know. You don't know who's behind the trade, if it's central bank that's manipulating price, or it's somebody at a hedge fund or institution that fat fingers a trade. You don't know. I don't know. The only person that knows is the person pushing the market around, right? So again, we're trying to play our edge out over a long series of trades, right? That's kind of the name of the game here. So this is why we suggest, again, starting with 1 to 2 prime setups in your trading plan, and practicing them until you've really mastered them, right? It's really all you need. Anything more, you're overcomplicating it. It's just going to make it more difficult. I used to have like way too many setups, and it just, how can you master it, right? There's this analogy that Blackwatch kind of told me. I think he got it from another trader that's pretty successful, but it's the whole idea of, if you're like a pizza shop and, you sell pizzas and burgers and hot dogs, and you're spreading yourself thin across all these different things that you're offering, when, really you could just be focusing on, selling pizzas because you are a pizza shop at the end of the day and you make really good pizzas. Isn't that going to affect your ability? If you're selling all these other things, hot dogs and burgers and stuff, I don't know, you got to buy the equipment for it, but you're kind of taking away from your ability to make really, really good pizzas, right? And if you specialize in pizza, you should probably keep on selling pizza because, you're good at it, right? So it's the same thing, kind of applies to trading. Maybe I didn't explain that the best, but hopefully you guys understand the analogy I'm kind of getting at there. And listen, it's okay at the end of the day to sit on your hands if you don't see a prime setup that fits within your initial trading plan. It's an opportunity to practice and train your patient's muscle, right? But again, if you are being overly conservative and not taking prime setups, that is an issue, right? So understand the difference, but nothing wrong with being conservative. You have traders like Dan that takes half the amount of trades that I take, literally, and he does honestly better than me. It's pretty impressive. So I like mentioning that. I'm so proud of Dan, the fact that he can do that. It's never a competition, guys. Remember, at the end of the day, it just kind of shows you the different types of systems that you can run in terms of risk management, and like anything can be profitable as long as you stick to it, and it's well developed, right? So let's quickly look at extreme systems and why they can be counterproductive. So on the left, we have a high R system with a low win rate, right? So 10 R on average, we're winning about 10% win rate. And then on the right, we have a low R system with a relatively high win rate. So on the right, we actually have something that's kind of representative of a lot of retail strategies. Now, here's the thing. I don't want to say that retail strategies are bad, because listen, they can work at the end of the day. I can tell you from experience, like when I was doing retail trading, I was either break even or a little bit in profit every month. It was fine, right? But now the one on the left, I feel like I've seen this a lot lately in this industry with other educators in this space, where they tout these like huge R trades. But the thing is, nobody's posting their MyFX book to kind of show like the system behind it, right? Like, how many losses are you taking to catch these huge R trades? And on top of that, how much are you risking per trade to actually catch that huge trade, right? Like your 100R, 500R trade. Like, I've seen 500R trades before. Now listen, I'm not saying that these guys aren't doing it. It's very possible they are, and if they are, great, like, good for them, right? That's honestly impressive. But thing is, right, without knowing the actual win rate and like knowing what they're risking per trade, we have no idea what their total loss risk is, the risk of ruin, right? And even if they're like, we don't know if they're actually like pulling positive R. I'm assuming they are, but here's the thing: if they're playing around with their risk, right, like maybe they're risking 0.01% risk on these huge 500R trades, and then losing a bunch of times with 0.5% risk. Like, what do you think is their equity curve is going to look like, right? It's not going to be pretty, right? So let's quickly look at the drawdowns to each, or the pros and cons of each. So high R, low win rate system can be psychologically tough to trade through losing streaks, of course, right? With a 10% win rate, it's representative of you winning 1 in 10 trades on average, right? So would you be able to handle a losing streak of 10 losses? I've done it personally. It's not the easiest thing in the world, but if you can do it, you can do it, right? I don't think most people can. It requires extreme discipline, obviously, but has a high potential profitability, right? Look at our average performance over 100 trades, 79%, pretty good, right? On the flip side, low R, high win rate system. So again, representative of a retail type system, right? Again, nothing wrong with it. Our average performance, 8.2%. Okay, not bad. If you're trading a huge account, I don't see a problem with that, honestly. It requires a high win rate to trade, and a high trade frequency for relatively thin profitability, right? And I'm comparing this more to like a more balanced system, like the one I'm trading, or the one that I think a lot of you guys trade in the Phantom community. Now the pro to it is it might be psychologically easier for you to trade if you can consistently hit that minimum win rate, and obviously if you're maintaining that win rate, of course, winning like every other trade on average is, it's not going to feel bad at all, right? That's a good system, right? Nothing wrong with that. Now, the only drawdown to it is you then have that expectation to maintain this super high win rate. So in a way, it could actually be psychologically, more difficult than you think. It's a little, it's kind of like a hidden, negative to it, right? Because if you have to maintain, 45, 50% win rate, and that drops down to 35%, and your profitable system very quickly becomes unprofitable, right? So something to keep in mind. Now, I don't think anybody in the Phantom community trades either of these systems. If anything, maybe they do the one on the left. But as long as we fall, into more of like a balanced system type of thing, like kind of what I'm trading. Again, mine probably is more, swayed toward the left, right? The higher low win rate system. It's fine. Look, I've made it work. It's not a big deal. I'm looking to improve my strike rate always, right? Whatever I can do to improve my trading, I'm gonna do it, right? And same with you guys. I hope you continue to work on your trading skills, right? It's very important. But yeah, that's it. On the next video, we are going to talk about the psychology of risk management. So I'll see you guys on the next one.